All right, guys. So good morning. Welcome to another installment of the 2016 saga. More big downside, China leading everything, very reminiscent of August. Very, very reminiscent of the summer last year where Chinese markets just began to dominate the global market landscape. Equities leading the plummet, but of course it's certainly I would say that the reasoning, well, I don't know, it's multi-layered, but one of the key reasons for the turmoil is yet again, devaluation of the yuan overnight. And in fact, the thing about it is this was the biggest, we've had 8 devaluations in a row, and this 8th one being the biggest. So the fears are continuing to grow. And then you've got in the equity space in China this circuit breaker scenario, which I don't know whether it's a good thing or not. I mean, certainly I think what's happening at the moment, this circuit breaker is just acting as a target for the market. All that's happening is the market starts selling off, and the problem is what happens if you're a trader in that market. You're thinking, well, hang on a minute, if we hit 7% down, well, that's it, I'm locked out, I can't do anything. My hands are tied as the circuit breaker hits and the markets get shut for the rest of the session. So quick, let me get out of my positions before the circuit breaker hits. But of course, this just means everybody stampedes for the door, trying to get out before the circuit breaker hits. This selling, of course, leading to the circuit breaker being hit. Here's the chart of the equity market in China this week. Sorry, that's Chinese currency. I'll come to that in a sec. Sorry, this is the equity market, this week. And this is the Shanghai composite. Of course, Monday, circuit breaker gets tested and triggers a close of the market. Tuesday, Chinese government getting the checkbook out and buying in force to stabilize the market, buying again yesterday to stabilize the market as the currency got devalued, and then overnight devaluation again as the Asian session starts, and there's no government involved here as they just let it go, I think. And it took 12 minutes. The market opened, 12 minutes later we hit 5% down. So that's the first trigger point on the circuit breaker. The market then shuts for 15 minutes. It opened again, 2 minutes later, hit the 7% down. That's it, done for the day. A 29-minute trading day, of which only 14 minutes you could actually trade. That's it, switch off the machines, go home. So quite extraordinary and obviously concerning. If you take a look at the 1-year chart for the composite here, then we are not yet down to August lows. August lows, well below 3,000. You can see we're 3,125 here after another 7% fall today. The low back in August was 2,927. So we have got room to go yet on the downside. This is a 3-month low, but that's all it is. And if you go back 5 years, and I know this chart, have a look at this on a 5-year basis. Even if we break that August low, which incidentally is a key bottom from January as well. Or no, well, we're trading around about that now. But anyway, my point is, if we break that August low, well then, sure, that would open the door to more downside. But, it only gets us back to levels we were trading at the end of 2015. You've got to understand with this Chinese equity market, we had a ridiculous rally in the first half of 2015. And this is just being unwound. It's just being unwound in spectacular fashion and is dominating global headlines, driving this panicked sentiment at the start of 2016. But you do have to understand that we had a 100% rally in the first place, which was arguably completely unjustified. So the fact it's unwinding now, rationally, shouldn't be that surprising. But of course, there's nothing rational about the behavior of this. Let's look at the currency. This is the yuan against, this is the dollar yuan currency this week. As you can see, it keeps stepping higher here. And the biggest one of all was today, and we're almost up at the 7 handle. If I just move that across, you can see on the y-axis we're up to 6.6 here. This is the lowest value the yuan has had for at least 5 years. And, it's, and we've just had key news out of China with regards to their currency reserves. And their currency reserves have dropped, and they've dropped by a lot more than expected. It's now down to $3.33 trillion. That's their dollar reserves, which is a hell of a lot, of course, but we were expecting 3.415 trillion, and that's dropping from last month 3.438 trillion. So basically, we've almost dropped $0.1 trillion. Where's all the money gone? Well, it's gone to prop up the yuan. So, just imagine if the Chinese government weren't propping this up. I mean, it's collapsing anyway, and that's even with the government trying to prop up the currency by selling their dollars and buying yuan. So you're getting a pretty panicked FX market, which is all a sort of function of this concern about Chinese growth generally. Just how bad is the Chinese economy? Yes, the headlines are taken by the equity market, but I think the equity market's a sideshow. It's the equity market behavior is a distraction from what's more important, which is the currency devaluation, because that has massive implications for the rest of emerging Asia. So you're getting the whole of the Asian space collapsing, well, not collapsing, but driving sharply lower in response to this. So this is, of course, dominating the global market space, and this is why you're getting the moves you see. So this morning, quickly then on Europe and on the US, big downside. S&P down 2.4%, DAX down 3.75%. The trapdoor has been opened at the beginning of 2016. With the DAX, I mean, this is 1,000 points now, just in 4 sessions. Well, if you go to the high on the 30th of December, was at 10,900. We're now 9,800. This is almost 1,100 points just in 5 sessions. So this is carnage, and you can see a key break on the DAX. We're just through the floor here. The S&P driving sharply lower, properly taking out these December levels, and the extension is huge. Now, at the same time, what's exacerbating this move is what happened with oil yesterday and what's happening with oil today. It's like a double whammy here. You're getting China collapse and panic, along with crude oil which is related, obviously. Crude oil suffering, the commodity market suffering because of the China story. But of course, yesterday we got this inventory data from the US, which, well, ironically, on the crude oil front, if you just took that in isolation, should have been bullish for price because inventories dropped 5 million barrels. But of course, it wasn't the crude number that grabbed the headlines. It was the rest of the inventory report, with gasoline adding upwards of 10 million barrels to inventories, the sharpest weekly increase in gasoline inventories for over 20 years. Also, distillates increasing sharply, 8 million barrels. Despite overall crude dropping, you still got Cushing inventories going up. So all this led to oil sharply lower. Yesterday, oil in one session down 5.5%. What's happened today? Another 4% down added to that. We were trading $36 yesterday. We're now down through credit crunch lows. Brent crude trading levels we haven't seen since 2004. Look at my weekly chart here for crude. Actually, forget weekly. Let's look at monthly. Here we are down at, I mean, it's just extraordinary, really. But we've got a bit of a conflict here, right? February 2009, I had a low here on my chart, 33.55. That's gone. Today's low is at 32.10, and that is, well, it depends what charts you look at, but that is thought to be a December 2008 low on some people's measure, which is what we're testing now. Remember, this is WTI crude. Brent crude's taken out the credit crunch low already, back to 2004 levels. Whether WTI has done or not is debatable, depending on what charts you're looking at. But we've certainly broken my level, but the other one, 32.15, has been tested. But if that breaks, it's the same as Brent, back to the levels not seen since the start of 2004. So this, I would say, ever since we broke the low point, ever since we broke April's low in the summer, the thought was, well, inevitably now we're going to test the credit crunch lows. It's just taken a while to get down here, but the inevitable has happened. So here we are. And now what happens? What happens now with crude? Now we've done what we thought was most likely. Credit crunch lows get tested. And where do we go from here? Now, what happens with OPEC? OPEC have had a policy that's really driven this move from $100 down to here. Their policy is carry on pumping and, in fact, increasing the amount we're going to pump, exacerbating the global oversupply thanks to shale oil production. So what do OPEC do? Do they now have an emergency meeting and cut production? Just how much pain can they take? I think there's a major problem in OPEC. I think the cartel has completely lost its unity, and I think they've got a big problem because ultimately they could cut production, but all they'll do is hand market share to Russia, because the market's so oversupplied that they can just cut production and all that'll do is just reduce the oversupply, handing market share to others. I think OPEC cannot act alone. Put it a different way. I think Saudi Arabia do not want to authorize an OPEC production cut without it being a coordinated cut with non-OPEC producers. And to put more simply, I don't think Saudi Arabia will cut production unless Russia agree to cut production as well. And what are the chances of that, given the diplomatic relationship between the two? I think I think it could happen. And if it did, it would be a dramatic event, and it would certainly call a bottom to this move. But can it happen? Diplomatically, can it happen? And I guess ultimately, it doesn't matter how much political bad feeling there is. There's nothing like economics and harsh economics to focus the mind and to bring politicians around a table and to get a deal done. You only got to look at the Eurozone debt crisis over the years 2010, 11, 12. Ultimately, when the economics get severe enough, the politicians do what's needed. So maybe we might you've got to watch that space. But this is my personal view. I don't think Saudi Arabia will authorize a production cut without Russia. So they were supposed to have a meeting in December before the OPEC meeting. Russia and Saudi Arabia were supposed to have a meeting. They postponed it. So I would say keep your ear to the ground on any meeting between Saudi and Russia. I'd say that would be the trigger point to people beginning to price in genuinely the chance of a cut. Now, in the absence of that, there's no production cut. And so we're in panic mode here at the moment, but it may well be these credit crunch lows that form a messy, and it's going to be very volatile. You could see $30 trade before we get any kind of stabilization. So we're right in the eye of the storm here. So China and oil are killing these equity markets. And as it stands, you've got very, very substantial downside. It's difficult now, though. Where do you go? We're already an hour into the European session. But when you're looking at some of these charts on a shorter time frame, here's the 1 hour chart for the S&P. Again, you've got to think, well, how far can these things go in one morning? I think you've had some great trades already, some high momentum breaks. It's just that now the DAX is 4% down. Things get less easy, or to put more simply, more difficult. That's because you're getting people begin to book profit when you see big figures, 4% down on the day. You're getting short-term traders booking profit. That means buying. It means the downside path, which is most likely still open, is going to be harder to tread because you're getting more profit taking coming in, making that downside less straightforward. Bond markets, of course, are continuing the risk off. So the Bund's up through the 160 handle significantly. Let's look at some of these FX markets. Forget euro dollar. I don't think it's that interesting here. It's not really. It's a difficult trade. I think the the FX space, it's the yen, of course, that it is the key risk-off barometer. A couple of you talking about euro yen this morning. Check out the euro. This is a good trade for people looking to trade the yen as a risk-off. And check out just on the long-term chart, we're approaching the 2015 low. New sort of 9-month lows this morning. Cable, very important here right now. We trade the 2015 low, 145.66. April's low last year. We're testing it as I speak. I want to just zoom back on a monthly chart to give you an idea where this is on the grand scheme of things, because this is a 5-year, or well, 6-year low. 6-year low this morning, because we did dip a couple of pips below that April low. So new 6-year low. You've got a level, let me add another line in. April's May 2010, pre-election cable weakness, back at 142.32. So if we break the 2015 low, that's the next target. So you're getting a lot of FX movement. Of course, all of it driven by the yuan. You're getting FX weakness across the board. The Aussie dollar testing the 70 handle. Last year's low against the US dollar. So dramatic scenes across assets, all triggered by China, with then the oil market significantly adding to the mix. So it's all dramatic times. Now, I mean, let's focus on the calendar for today. I haven't even mentioned the Fed. I mean, the Fed, before we look at the calendar, the Fed had their minutes last night, but I mean, forget that. Really, honestly, it's not even relevant here. I mean, the minutes. I mean, I have to cover it, but the minutes were by and large uninteresting. As expected, I said this yesterday. The minutes are not going to contain much new because Yellen had a press conference. But in terms of what they did contain, that you might, if you're really trying, you might get a whisker of dovishness out of it, was the fact that there were comments from officials suggesting that last month's decision to commence liftoff was a, quote, close call. So this might, if you're really, really trying, you can get some dovishness out of that, because it might reflect concerns around the outlook for inflation in particular. The text in the minutes revealed that for some members, the risks attending their inflation forecast remained considerable. Among those risks, downward shocks to the prices of oil and other commodities, and then a sustained rise in the dollar. They were worried this would lead to, or would damage inflation, and therefore would not justify interest rate hikes. Okay, but other than that, it was all, contained no information that was new. So forget about the Fed minutes. The moves this morning have nothing whatsoever to do with the Fed minutes. Okay, it's all about China. It's all about oil. Let's look at the calendar, but really, again, this isn't really relevant, even though we've had some German retail sales figures, so on. We're going to get some Eurozone retail sales figures at 9 o'clock. I mean, that is, I guess, the most important data of the morning. On the retail sales figures out of Germany, they were weak on the annualized measure, but strong on the month. Oh no, sorry, weak, yeah. So on the month, 0.2%, we had expected 0.4%. On the year, 2.3%, we had expected 3.7%. So bad news on German retail sales. Factory orders, though, went the opposite way. Strong German factory orders at 7 o'clock. So mixed data from Germany. Now we have the retail sales figures out of Europe at 10 o'clock, just for what it's worth. We're expecting 0.2% month on month, which will be a lift into positive territory for the first time in 4 months. We've got to go back to July to see the last time we got a retail sales print in positive territory. We had a good sort of back end of 2014, first half of 2015 on this, but the second half of 2015 has proved to be weaker. We got jobless claims this afternoon, but this data, honestly, it's not really that interesting when you've got such a dominant force, which is China and which is oil. All right, so that's where your focuses should lie. All right, let's get back to it. That's the briefing done. Next data is, well, in 2 minutes, but forget about it. It's Eurozone retail PMIs. That's not important. But otherwise, it's the 10 o'clock retail sales figures from the Eurozone. All right, guys, enjoy the session.